I want to get your take on the market reaction yesterday to the EU trade deal and also the fact that we have these ongoing conversations. I don't know if you were listening earlier. Jim Cramer says essentially the market's kind of over this tariff fight. It's more focused on earnings, which are going better than expected, the Fed and the jobs report. Agree or disagree?
Strong agree. If you layer on the S&P 500 over sort of a markets-based recession odd probability for 2025, they look almost the same in inverted. So as the recession odds went up throughout March and then acutely in April, the market was tanking. And as those recession odds have receded, the market has recovered. And a lot of that is down to either the tariffs being scaled back initially or the market just learning to live with 10 or 15% tariffs across the board on some of our largest trading partners, and the data continuing to come in on the weak side, but not showing any significant sign of deterioration to the point where we'd expect there to be a recession or some kind of significant pullback.
All right. In all fairness, the market did hit a new high yesterday, the S&P, but it was like 0.02%, like eked it all the way out. At the same time, we're really concerned about some froth in the market. I want to read to you something from Bank of America. They said last week their clients were actually net sellers of U.S. equities, $1.4 billion after they bought the previous week. And then they said clients sold single stocks after buying the prior week and continue to buy ETFs for the 14th straight week. Is this the sign of froth that we should be concerned about, that maybe the market has hit at least a temporary ceiling and people feel like it's getting ahead of itself, whether it's valuation or just some of the risks that are out there?
The signs of froth are really everywhere. If you think that a lot of the rally back that we've seen in the S&P 500 to all-time highs has been about decreased recession odds, well, those recession odds can only go so low. And then from there, we really need to see better earnings, better data. If we're seeing the market rise without those things, it means that there is, by definition, froth speculation in the market. And there's so many different analyses out there. High beta stocks, riskier stocks, are in their sort of 99th percentile in terms of their performance. We've seen positioning move from very light in the equity market to now a little bit more aggressive than usual as well. And then the amount of speculation that we're seeing, the amount of trading that seems to be driven by retail investors speculating on individual stocks, that is also at a very high level. So all these things that we saw to a much greater extent in the end of 2020, beginning of 2021 with meme stocks and with a lot of liquidity in the markets, we're seeing that rhyme so far in 2025 as we kind of hit here coming into August.
All right, we're going to spend a lot of tomorrow and the day after talking about the Fed, but right now I want to talk about tech. We do have some big tech earnings coming up with the idea that we're going to at least see potentially an extension, the temporary tariff reduction with China, maybe even a deal. And these trade deals, in all fairness, do seem to be coming together. Is right now the time to really invest in tech? Of course, we have Microsoft and Meta coming up on Wednesday.
Yeah, I mean, this is an area that's going to be more or less resistant to sort of the secular slowdown that we might be seeing in the economy. So if they're seeing weakness in some of the labor market data, maybe more of the consumer data, tech has been able to kind of wade through that, provided we're not in an acute recession scenario, which doesn't look like we're going to be. And tech has obviously been the big beneficiary of all this incremental scaling back in tariffs. Are we going to see a little bit of a bump up in some of these tariff rates with some of the countries that we are doing a lot of tech-related trading with? That's still possible as we get into this August 1st deadline. But these companies are continuing to post solid earnings with good outlooks for the future. And if you're looking at the rest of the economy growing at about 1%, this has been the kind of environment where tech has been able to do well, not just in the last year, but in the last decade. When we're slowing down, when growth is hard to come by, these high growth companies tend to get a closer look.